There is a right to win today, you're saying?
Yes, yes. India was priced to the perfection in September 24. Economies and the markets priced for disaster.
Certain asset classes will be left too much to do. What do you think about gold and silver?
India has signed trade deals with 70% of the world economy.
Good macros does not guarantee good returns.
Are they asking this question from the perspective of investing more, or are they asking this question from the point of validation? Rarely, the top performing asset of 1 year does well in the next year.
Are you optimistic about IT as a sector? Are you buying? Markets change, narratives shift, but the right perspective, that's what really matters. Today's guest on our show is someone I've been really curious to talk to for a very long time. Mr. Neelotpal Sahai is Director Indian Equities and Head of Offshore Advisory at HSBC Mutual Fund. He looks at Indian markets not just from the inside, but from the lens of global capital as well. That's a rare vantage point, and it makes for a very, very different conversation. Now, we have a lot of ground to cover. We'll be looking at where we are in the market cycle and also what global investors are thinking about India right now. So, without further ado, let's get wiser. So, Mr. Sahai, thank you so much, first of all, for doing this with us. We're very glad to have you here. We're talking at a time when uncertainties are kind of easing. At least to us, we feel it's easing. Uh, Domestic macros seem stable. Commodities are at an all-time high. Now, in this phase, how do you think investors should view this cycle, and what exactly should investors do?
Thank you. Thanks, Arun, for having me on the show. It's a very interesting question to start this conversation with, actually, because there are multiple points embedded into this one question itself. The first thing itself that you mentioned about the uncertainty is easing. Maybe somebody will differ with this opinion. Maybe I will also differ in the sense that last year was one of the years with too many geopolitical tensions. In fact, something that we have not seen in quite a while, maybe since the Gulf War or since the Iraq War and things like that, actually, and even in our country and the neighborhood as well. Second thing, the trade frictions were also of the very high magnitude. In fact, again, that was also not something that we have seen since the WTO days, actually, and it was in the completely uncertain domain. So we are talking about two of the major uncertainties. Obviously, at this point of time, the things are stabilizing and a lot of uncertainty is over. But last year was a period of very high uncertainty. And these are the some things actually where the global capital flows are very important for them. And so much so that they do actually impact the global capital flows. But I do completely agree to your second point on the domestic macros. We are fine. The growth rate is good. Inflation is under control, low and under control. Interest rates and the monetary policies are supportive of the growth. Even the fiscal policy is also supportive of the growth. Actually, so to that extent, actually, the domestic macro is fine. But when it comes to the crux of your question, which is about the uh, where we are in the market cycle as such, actually, so I would say that the key point which I look at from the market is the valuation and the earnings growth. Maybe we will delve deeper into those in subsequently, but let me at least address them here uh, so as to complete this question. The thing is that the valuations have corrected quite a bit from the September 24 peak. For the large caps, they have gone below the long-term averages also to some extent. Mid cap and small cap are still higher, but they have also corrected from their peak. On the other hand, the earnings actually have now beginning to show signs of acceleration. There were 4 or 5 quarters actually when they were down and into mid single digit sort of thing. And for the last 2 quarters, we are actually beginning to see that there are no further downgrades in the earnings, which is very important, very crucial. So I would say that we are into a recovery phase for the market, not necessarily the start of a new bull market.
So it's just a routine recovery
Sort of
phase.
thing,
Okay.
because there are certain other conditions which are required for somebody to call beginning of the next bull market.
Like what, sir? Like,
So two important points. Firstly, usually that what we have seen in the past is that the valuations actually compresses quite a bit and comes significantly below the long term average,
right.
and then the cycle begins, and then obviously you make a lot more money than the purely earnings
So
growth.
we're not there.
We are not there. We, like as I mentioned, for the large cap just below the long term average,
Okay.
and for mid and small cap is still higher than that.
Even
Yes.
after all this correction, you see mid
Yes.
and small caps are still. Uh,
Yes, yes.
okay. Okay.
Second point, even more important, is that some of the crucial elements for the any long-term bull market to begin. So there should be credit expansion. So it was a bit of lackluster. Now in this quarter, we are seeing low teens to mid-teens kind of growth in the credit expansion, which is good actually. We should see the private sector capex, which is still kind of elusive, is there, but kind of elusive. A clean balance sheet, which is there, by the way, actually. But more importantly, there should be visibility of long-term sustainable earnings. Now, we are beginning to see that companies are guiding towards the recovery in their business operations actually, but still nobody is making a commitment for a long-term sustainable
Capex. Yeah.
capex or the recovery in their business. So I would say some of these things are missing. Maybe we can be there in about a year's time or something. I don't know how the things pan out actually, but as of now, possibly it's too early to call beginning of a new cycle.
Right. So we're
Yeah.
just in the recovery
Yeah,
phase.
but definitely it's a recovery. So last 4 or 6
But
quarters
much,
was down.
you're also
Actually,
categorically saying that we could possibly be much better than where we were a year and a half ago.
definitely. So it is not. Maybe that I sounded pessimist, but I just want to be clear. No, we are not in the pessimist zone because I will reiterate the point that the macros are fine. The earnings growth are recovering. Valuations are moderated actually also. So it's not a cause of concern. It is just that I just don't want to be overly bullish at this stage
Bullish at this
actually.
point of time,
Yeah,
right?
overly bullish. No,
So cautious optimism.
I'm positive. I am positive.
Okay.
I'm purely positive, but not overly. I would keep that in the back
Right.
of the mind.
Right.
Yeah.
So interestingly, when we met in Mumbai last year uh, for the event, both you and your teams, somehow you were extremely bullish about the emerging markets,
Yeah. Yeah.
and rightly so, right? Because it's played out. You see the kind of returns that emerging markets have given over the last 1 year, especially. It's done well, except for India, of course. Somehow India has not got the flows, and the popular narrative here is that we're not in the AI race, and hence we've not got the
Yeah.
flows, right? But do you think that's just it? Do you think it's just the AI story, or do you think there's something beyond that, and that's why we're not getting flows? I'm asking you this specifically because you also look at the global side of things. So you have a clear view on how global investors are thinking, right? So is it just the AI story that's not playing out, or is something else?
Again, a very relevant question actually, and especially because we are advising close to about $5 billion for the various money from different parts of the world, and we are seeing earlier inflows, now some bit of outflows, and we have got some understanding of like what the investors are thinking. But absolutely right in saying that emerging markets have outperformed India over the last again 12 to 16 months or so in a massive manner, and so much so that for the calendar 25, the kind of underperformance of India as vis-a-vis emerging market we had not seen in over 20 years, actually, even
Wow.
longer maybe.
Right.
And if you are looking in dollar terms, the returns would be even worse because we
Mm.
depreciated and emerging market currencies appreciated, so even worse. However, I would not put everything onto AI. In
Okay.
fact, I would say that AI is just one of the side sources.
Okay.
I'll go back to my same two themes actually, the valuation and the earnings
Mm.
growth. So let's look at, and maybe I will throw some numbers actually, but
Sure.
I will
Sure.
try to
Please.
explain in simple thing actually, is that India MSCI, and here we'll talk about the MSCI because that's what the global investors use. So MSCI India P multiple usually trade at a premium, significant premium to MSCI emerging market PE multiple. If you look at the last 10-year average, this is close to about 60% premium. But this peaked, it went to 110% in September 2024. So that was much higher than already high premium that we are having actually.
Okay.
At the same time, it should also be noted that we get this premium on account of the fact that the earnings growth in India is typically higher than the emerging market. And in the post COVID scenario, it was almost 6-7% higher than the MSA emerging market earnings growth story. So, to that extent, this some bit of premium was justified also. Now, fast forward and then pause at the September 24 or maybe in the quarter after that period. We are at a situation where India's multiple were at close to all-time highs, a couple of standard deviations higher than the long-term average.
Hmm.
Growth was stalling, coming down from the a low 20% kind of earnings growth to mid-single digits, significant deceleration. On the other hand, economies and the markets like China and Korea, etc., were at multi-year lows in terms of
Correct.
valuations. And with the AI story coming in, the markets like Korea and Taiwan, etc., were showing reasonable earning growth.
And it was almost like global capital just needed a reason now.
Absolutely right. So global capital is unemotional. It
Right.
looks at the bare bones of it actually, the where the valuations are the risk reward, where the valuations are attractive,
Hmm.
and where the growth is coming. So from a situation where we had higher growth, we came to a situation that India's earning growth was weaker than that of emerging
Hmm.
market, and their valuations were cheaper. So it was only natural and only commonsensical
Hmm.
that the global capital would have flown there. And in fact, they saw an inflow and we saw an outflow to the extent we had not seen before. And the rest is history, that the kind of underperformance you have seen. Now we are at a situation where the valuation premium of India has gone back to the average level of about 60 odd percent,
Okay.
and the earnings growth in
This
India.
is from 110%, you're saying.
Yes,
Right.
yes, yes, correct.
Yeah.
And the earnings growth of MSCI India will be roughly in the similar ballpark of mid-teens sort of thing, which the emerging market would be. So
Okay.
it's still not meaningfully higher than what India used to have in the previous 3-4 years,
Right.
but it would be mostly the same. And obviously now that earnings growth is coming on account of the AI related stuff also, and apart from some of the other industries also doing well here. So I would say that from here onwards, India could be on par with the emerging market.
Okay.
The period of underperformance is over, but do one builds a case for the outperformance is still too early. So for
Got
that,
you.
we need to earnings growth has to be higher than that, or their AI bubble has to now shrink.
That has to fall.
Yeah,
Okay.
correct,
Okay.
correct.
Okay. Interesting. So you're saying uh, it was not just the AI story, it
Yes,
is a valuation
and
story,
earnings growth.
earnings growth story, plus, you had the AI story playing out, and hence you saw outflow of capital. And that's where most of the emerging markets kind of got money, and,
And not to mention, some of our major sectors got negatively impacted on account of AI.
right, right, yeah. So
Yeah,
adding all of that, so multiple
yeah,
factors coupled together, that's where you saw,
yeah.
capital moving out. And do you think, you know, uh, global capital still thinks like that, or
No,
they're
so
okay with valuations today?
actually we saw over the last 1 month some inflows are beginning to come actually.
Right.
So it's no longer that crystal clear trade which is there in favor of the rest of the emerging market versus India, because now India is also showing pockets of where the earnings growth
Also, have you
has.
noticed like the post-tariff situation easing a little bit?
Yes,
Have you noticed that flows have kind of at least slowed down? At least outflows have slowed down.
actually it's inflows actually.
It's inflows. Okay, okay,
And
okay.
the currency also appreciated on
Currency
day one,
appreciated.
massive appreciation. So now a lot of those headwinds actually has gone away.
Okay,
Uncertainty when the deal would be signed.
right,
In fact, now we are in a much better position
right.
than the status quo also when it comes to the trade tariff numbers, etc. Actually, so the things are looking better. I mean, to add to
Perfect,
your the first question as well.
perfect. So when we look at your funds, specifically your funds, you've been fairly large cap biased.
Yeah,
And so you give, at least from our, from the answers that you've given, you give a lot of importance to valuations, right?
absolutely.
So,
Yeah, yeah,
and
yeah.
considering valuations, it really makes sense for you to be in large caps, and rightly so. And last year it's worked. I mean, you take out commodities out of the equation, large caps gave
Yeah.
the best returns, right? Uh, but where is the velocity of growth today in large caps, right? What sectors will drive that velocity of growth?
Yeah. So first, let me just answer in a manner that okay, the three funds which I manage actually are the large cap fund, where By design, I have to have more than 80% into the large cap stocks.
Correct.
The second fund is a focus fund where I have to have only a 30 stocks, a maximum of 30 stocks. So quite obviously, because it is a high conviction portfolio, so there will be a fair share of the large caps. And the third one is a balanced advantage fund where the underlying benchmark for the equities is Nifty. So
Correct.
again, some tilt is there. But having said that, let me clarify that at least in the focus fund and in the balanced advantage fund, I've got a fair share of mid and small caps
Okay.
actually.
Okay.
So it is not that I'm shunning them actually,
Okay.
but okay, some bit of this bias of the large cap is also an account again for the same reasons actually, is that the moderation of the valuation in the large caps actually happened lot more and much more reasonable as compared to mid and small cap.
Hmm.
Secondly, that the earnings growth revival has happened in the large caps a quarter or two ahead of the small caps and mid caps, which is happening right now. Mid cap was very good in the last quarter. The small caps are okay in this one, but the large caps has been recovering slightly earlier. Secondly, the phases of the downward revision of the earnings for the large cap is also largely over. We have not seen the downgrades in the last couple of quarters. So those also may be the reasons. But the second part of your question is equally, if not more important, is the sectors that we look for actually.
Yeah.
So at least I do not look at, because large cap, mid cap, and small cap are just the labels
Hmm.
given artificially by us actually. The companies themselves do not know that they are large caps or mid cap and small caps. So they are the businesses which are trying to create value for the investors
Right.
actually. It
Right.
is us that we have given them. So we are looking from that perspective itself.
Right. Right.
So there are three pockets where I see that the earnings momentum is there, earnings growth momentum is there. One is in financials. So after a bit of moderation last year, now we are beginning to see credit growth coming in, and the NIM compression will also stop, if not begin to expand. So when the rate cut was there, so the NIMs were compressing, but now it should begin to expand. And the credit cost is also well in control. So you should see the earnings growth to come back to the financials, especially the lending sector. The second bit is in consumption. We saw direct tax cuts early in the last budget and indirect tax cuts, GST cuts in mid of the last year, just before the festival season. We saw some uptick, but then it died down after that. But the net impact of these two cuts is there in the system, and possibly the monetary policy is, which is also supportive, also means that it will begin to come back. Equally importantly, next year we will have the eighth pay commission coming in. So although it's still about 18 months away from here when the actually the money will come into the hands of the people, but there can be pre-buying because it's almost certainty that the arrears would be paid, and then there could be people pre-buying. And one of the points which does not get discussed, and these are the points which usually get discussed in all the consumption discussion, but I would add another point actually. The lower inflation which we have alluded to so far also means higher disposable income in the hands of the consumers,
Correct.
and that is very meaningful. In fact, the impact is much higher than many of these tax cut benefit coming into the hands of the people.
Correct.
So all this means actually that it's a matter of time, that maybe next year is that the consumption will also begin to see revival. And the third pocket is that after again 2 years of flattish number, infrastructure has seen some growth in this budget estimate. So we are hoping that at least some part of the infrastructure, the power and the defense, etc., will actually see some growth there.
So that's where you're seeing
Yes,
the
in the
real
large cap
velocity
space.
of growth
Yes,
to come in.
yes.
Perfect. So I'll go back to the global mandate piece, right? You said roughly about $5 billion now
Yeah.
of global advisory, right? There was there was a lot of optimism, sir. 23, 24, even beginning of 25. Sone ka chidiya, yeah, Amrit Kal and India's century and all of that. Somehow it kind of vanished, right? What I want to know is what are global investors really saying about India today?
Yeah, so let's look from their perspective.
Hmm.
Like any other investors, they are also looking for predominantly returns on a risk-adjusted basis. So do not take extra risk. One additional variable for them is the currency also,
Hmm.
which in the past was more stable in the period that you talked about, 23, 24, 25 was not one of those periods
Hmm.
where actually we depreciated much more, and hence
Fair
their
enough.
returns got compressed. So they are largely looking at the returns from in the dollar terms. But I should also add that they are not necessarily looking in the near term return actually, although
Okay.
many times that is at the top of the mind of the people actually,
Yeah.
because okay, this year we have not performed, so what are they actually, are they changing their opinion or mind or not? But a lot of them actually are
So
thinking from.
are they really medium to long term investors or?
Yeah, come to think of it, if you
Okay.
look at last year's outflow also, which is $17 billion in
Hmm.
the total investment of something like 700 or 17%. So yeah, 700 billion or 750 billion. So that is the total investment that they have got in India. So 17 billion went out, or some number. So that's about 2 odd percent. So
Hmm.
maybe actually, it is a meaningful change from what we have seen in the 20 years, 25 years actually, because we have
Correct.
seen that those kind of outflows, but not as compared to what investment they already have in the country actually.
Okay.
So coming to your question, actually, obviously their view changed on account of the fact that some of the other emerging markets looked significantly more attractive.
Okay.
So there was a situation when India was priced to the perfection in September 24,
Correct.
and economies in the markets priced for disaster.
Right.
So there was an asymmetry in the risk reward expectation. So it was only natural that the global capital, which is non emotional and comparative, will move from one bucket to the next bucket. And some bit of shift actually happened. And that actually also moves the market in some manner. So the returns actually were also
Fair enough.
very different. However, again, like they are beginning to come back. However, also at the same time, they are beginning to look at India from the medium to longer term perspective, because India's medium to long term outlook is unchanged. As we discussed in the very beginning,
Yeah.
the domestic macros are strong. There is a political stability is there. Now, with the signing of the trade deals, India has signed trade deals with 70% of the world economy.
Correct.
It's among the highest in the world now, from among the lowest just about a month or month and a half back, after signing deals with EU and the US. So
Correct.
now we have got trade deals with almost everyone. So there is a political certainty is there. The inflation is on the lower side. The policies are supportive, and the reform measures have been taking place. So all these factors are in place. What was missing piece was that the earnings growth was decelerating and the valuations were high. So after they have corrected in the last year and a half, and earnings growth begin to move up, so things are falling into place for FIS to begin to come back. Now, as I mentioned, is that emerging market is also doing reasonably okay. So I'm not very sure that India will get more share of its inflows, but it should get its fair share of
There
inflows.
is a right to win today, you're saying.
Yes,
Okay.
yes, there is a fair share. Yeah,
Okay.
absolutely.
So I'll switch into a very cliche question. Okay. I hate to ask you this honestly speaking, I hate to ask you this, but what do you think about gold and silver?
So, in some manner, this is asking like a barber actually whether you need a haircut or not. But I will try to answer this. See, I'm an equities person actually.
Yeah.
So, and that's a equity, that's an asset class which I understand deeper. I understand it better. I have seen it for a much longer period. Gold and silver, I do not look on a day-to-day basis,
Right.
but I do understand where you're coming from.
Yeah.
The thing is that they have given an outsized return in the last year or 2 years or so, and which is why it's attracting so much of interest. So maybe let's think from the investor's perspective. If
Hmm.
investor is asking a question, are they asking this question from the perspective of investing more, or are they asking this question from the point of validation? They've already done this now. What should one be
Hmm.
doing it actually?
Hmm.
If you're asking this question, so that is the kind of a trader mindset. So, asking this question from the perspective that whether they should come in or not, then one should realize that rarely the top performing asset of 1 year does well in the next year.
Correct.
And this data is available. This comes in beautiful table and chart,
Correct.
so everybody is aware of that. So still people ask this question, so maybe they are just trying to find a validation that they're in the right place, or wanted to say that okay, we did the right thing. Having said that, let's also examine why gold suddenly did well so well. So there was a bit of geopolitical uncertainty.
Hmm.
Central governments were actually also buying gold, diversifying their forex reserves. There was a lower interest rate, and kind of some bit of uncertainty was there. Gold normally flourishes in those times.
Hmm.
So the key value of the gold or any precious metal, silver also, is in on account of its able to protect the value which is embedded into this one. They do not create value. The
Correct.
value is created by the equities actually on account of compounding of the business operations.
Yeah, cash flows and
Yeah,
dividends and yep.
correct. And but the gold and the precious metal, they protect the value.
Right.
So this is an important distinction that an individual should make, that you want to create value or protect value. Now, the gold and silver should not be looked as a replacement for equities.
Okay.
It should be an asset allocation tool
Okay.
that predominantly the creation of value will come from the equities, but the protection of the part of the value will come from the gold and the precious metal and silver.
Hmm.
If one looks at that perspective, then one will look from the terms of the asset allocation
Correct.
rather than relative risk return.
Performance and all of
Yeah.
that. Yeah.
So gold must not be looked from the perspective of the return maximizing.
Hmm.
That would be a wrong way of looking at things. Then we are only just changing the past performance
Past
of last
performance.
year, and which usually actually ends in not
Like
so
what happened with
happy
small
ending.
caps in the earlier cycle.
Yeah, so it
Yeah.
doesn't end in happy ending actually usually. So I would say that the key point is the creation of value from equities, protection of value from the gold,
Hmm.
and gold should not be looked from the maximization of the return perspective, but the protection of the value, and it should be looked from the asset allocation rather than the
Wealth creation, so
wealth
to say.
creation, sort of
Yeah,
say.
yeah, yeah. But similar narrative for silver also, because
Yes.
silver you have an industrial demand angle also there.
Yeah, but that's limited to 1,600 or 16,000 some tons, or basically which is there.
Hmm.
So it's limited to that. Actually, that is not growing that much. It is just that suddenly the price moves up, so it attracts a lot of trader interest is there. So industrial angle which is there, but that growth element is lower than the overall global growth angle.
Okay.
If that comes, we will see actually what happens.
Okay.
So
Okay.
I hope the answer is not as cliche as you
No,
mentioned.
no, no. Answer is not cliche, sir. But my question is, I'll jump to another cliche, right? And I have to ask you this about the Indian IT services sector,
Sure.
right?
Yeah. Yeah.
And it's a it's a topic widely
Yeah.
discussed today, right? And most of them have, and especially we're having this conversation in Bangalore, and
Yes,
this
yes.
this
And
this
yesterday,
is
one of the IT companies had an AI day.
AI day, exactly,
Yeah,
right? So, and we're talking also when the AI summit is happening,
correct.
right, in the
Correct.
country. So, what do you think about that sector, right? You think the story is done, or you think that this is the beginning of a new era for them?
Very relevant question. And this is definitely not a cliche because this is of paramount importance. A lot of
Absolutely.
money is invested into this sector
Yeah.
and a lot of jobs also at hand,
Yeah.
actually. So now let's actually look at and try to break down into the smaller problems, basically. Then we can possibly come to some sort of clearer answer, actually. The first thing, put it very simplistically, from the claims which are being made is that the code writing can be expedited. True.
Okay.
Implementation of these code writing can be expedited. What was somebody claimed that what was done in 2 years can be done in 2 weeks. True, it can happen basically. So this brings us to, again, I mean, if people are extrapolating and saying that the job of all the software coder or the implementers of the SAP, etc., will vanish. Well, it is not so easy, not so simple actually, because one is defining the problem in a very narrow manner actually.
Hmm.
In the sense that let us look at the work done by these Indian IT companies and convert into two, firstly, simplistic bucket actually. One is the new code generation or new application development. That is where clearly the AI will have its advantage
Okay.
because of the reasons that they have got. But there is another piece actually, and which is a much bigger piece, incidentally, of the total spending by the enterprise. And the word is the enterprise itself, the enterprise applications, the legacy systems, the maintenance of those systems, and if the migration is required, the migration of the older legacy systems into the newer applications. That requires, and that's where the Indian IT companies actually do well, that requires understanding of the enterprise workflows, that requires regulatory positions, that requires system architecture, and in most cases it is not just one technology. There are layers of technological system built on top of each other. There were different system in 60s to 80s, 80s to 2000. In the last 20 years, it's all different actually. They're sitting on top of each other. Who knows them actually? Who understands them? What is the logic logic embedded into them. This is not the job of the AI. This is the job of the people, either in-house people or the IT services people, an outsourced job actually. That is not going to go away. That's not what I think actually. In fact, if at all anything, it can accelerate the work actually. AI can accelerate the work of migration of the older legacy system into the more modern system actually. So it can accelerate the work.
Okay.
So let me answer this way actually. If we define the work in a very narrow sense, actually, then okay, AI is going to take over. But if we take a complete holistic view, then IT services would remain intact and can flourish also. Now, having said that, the timing thing is very important. What
Hmm.
it may look like in the near term, short term, and because of the news flows and various announcements by these AI companies, actually, it may look like a doomsday scenario. But I think there would be after maybe 6 months, 1 year. It's difficult to set a time frame. Maybe 2 years also. The things will look better, much better for the Indian IT. That's what my opinion
That's
is.
your opinion.
Yeah, yeah,
Yeah. So a follow up to that, right?
yeah.
So I know you don't talk stocks and you don't want to get into businesses and all of that and specific brands and names, but what are your analysts doing and what are you doing? Are you optimistic about IT as a sector? Not even optimism. I don't want to talk about optimism, but in this fall, are you buying? Are you seeing that it's okay where it's in our territory, or you're not doing anything, you're just holding?
So maybe I'll generalize rather than saying what exactly
Sure.
what I am doing actually. So if somebody does not have an IT or in their
Hmm.
portfolio or something,
Hmm.
now they should be beginning to look at this because there's quite a bit of sharp correction in the valuations in more
Correct.
recent
Which is why
terms
I'm asking
actually,
you this. Yeah.
and it is factoring in kind of, someone mentioned that it is a negative terminal kind growth kind of thing,
Okay.
which might be true for the first year or something, but after that the growth will begin to come back. Uh, uh, so those people with zero allocation or very little allocation may should look at that actually.
Okay.
Uh, our position is different. I mean, it's available in the fact sheet in the
Correct.
last monthly thing actually. Uh, um, so I'm not saying what exactly we are doing actually. So that would become clear
Hmm.
when the fact sheets are
Fair
disclosed at
enough.
that point of time.
Fair enough.
Uh, but clearly, I'm not in the camp of, I hope, I mean, of the doomsday
Yeah.
thing actually.
You're not in the doomsday camp.
Yeah,
Hmm.
but I have no reason to be overly bullish. It is just about now the risk reward is tilting slightly in favor of,
Favor of the sector.
yeah, yeah,
Right. So we spoke about domestic macros. We spoke about the global situation. I really want to kind of get into the funds by itself, right? So you also manage a hybrid strategy,
yeah.
right? And now with uh, SCTs on arbitrage, and fixed income has kind of been in a limbo for fairly a long amount of time now. Uh, do you think, especially in the hybrid piece, right? And we've been constantly talking amongst ourselves within the team also, how should we view this? I mean, do you think there'll be equities and commodities will be left too much to do in strategies like this, right? Because if you look at a strategy that you're managing, which is the balance advantage, which
Mm.
is nothing but arbitrage, fixed income, and equities. Now, you have, I think, 50 basis would be the impact with STT coming into play. I'm not sure. You know
Yeah.
the math better.
Mm.
And fixed income is somewhere in that 5-6% ballpark.
Mm.
And even if we have to look at a reasonably good return, which is what we've historically seen strategies like balance advantage and all of that do, do you think certain asset classes will be left too much to do?
I think it's a very good question and a very nuanced question. I think investors should be thinking in those terms actually. So let's try to understand. As you already mentioned, that the scheme that which I manage actually has got three asset classes: unhedged equity, hedged equity, and the fixed income.
Hmm.
There is no commodities into this
Correct.
one. There are
Correct.
other things also.
Correct.
So what are they meant for? The unhedged equity is meant for giving growth to the overall portfolio. The hedged equity is meant to ensure that the total equity allocation goes over a certain threshold, so that you get the equity taxation.
Correct.
And fixed income is the remainder of the portfolio.
Correct.
Uh, the what we compute actually is the unhedged equity portion, and that is based upon largely a valuation based determination. It is based upon trailing 12 months and the future 12 months price to earnings and price to book of the major indices actually, and then based upon that with our internal metrics we come up with a range within which the mm, uh,
Equity
uh,
allocations are moving.
unhedged
Unhedged
equity will
equity
motion, and
allocations.
the remainder will go into the hedged equity, the arbitrage portion,
Correct.
so as to get the equity taxation. Now, let's say, and this is not the actual number. Let's say earlier the hybrid funds or the balance advantage fund were giving a return of 10%.
Okay.
Now, on account of STT, etc., they will give somewhere between 9.5 to 10, maybe 30 basis point loss on account of STT or something else. So somewhere between that. Now, if we are saying is that in order to achieve that 10%, one begins to take little bit higher risk
Hmm.
in the unhedged
Equity
equity
portion.
portion or increase this. So I would my response is that it would be more detrimental because it will begin to change the DNA of the fund, the nature of
Absolutely.
the fund for the reason for which the investor has come. The investor has not come here for purely out and out return actually.
Absolutely.
It has come for a combination of stability and the lower volatility in the returns, and the return expectation and the risk expectation should be managed within a range. So that should not happen.
Hmm.
So what is actually important, possibly I'm throwing the ball in your court, is to tell the investor to reset their expectation.
Expectations.
Yes, that it is not 10, it's now 9.75. It's on account of the regulatory changes, and let's not change, and possibly this will change for every fund actually.
Hmm.
Uh, and let's not change the DNA. Let's not begin to chase returns in this fund. If
Hmm.
that where one has to do that, then possibly the overall allocation itself can be changed.
Correct. Then
So
maybe you can look at a aggressive hybrid or something else, right?
something
Yeah.
else
Yeah. You
actually,
don't.
or
You,
maybe a little bit more into overall equities or
correct.
something else.
Correct.
So what we are actually doing is not doing anything different from what we are doing earlier actually.
Okay. Okay.
And maybe we'll reset the expectation. Like I have tried to answer to your question,
Hmm.
which was a very good question, nuanced question. Maybe we'll try to explain the situation
But
to
from
other people
your house
also.
point of view, you don't want to
Chase that higher
chase that
25
higher.
basis points.
Yeah, you're like,
Yes,
okay, I'll stick to this particular
yes,
allocation, and
yes, yes,
maybe we'll have to taper expectations in that segment.
yes,
You
yes.
think that will be an industry-wide phenomena? You think
It
that's
should
what?
be. That is how it should be.
Hmm.
Otherwise, it will begin to lose its purpose. Somewhere, then again, people will begin to compare with pure equity. So then the returns will never match up with that, actually.
Correct.
So it is meant for a particular purpose of a return in a particular band with a much lower volatility and much lower, hence, much lower drawdown risk as compared to pure equity. That should not get compromised, actually. And let's say if my method suggested 50%, it's just again a hypothetical example, and in order to chase return I go to 55%,
Hmm.
then probably I will end up having higher drawdown when the things turn sour actually. So things look good, so the returns comes, but I have to also manage the downside actually. So that should, I think the fund manager should keep in mind actually.
Basically, be true to label BAF and don't go
Absolutely,
beyond
yes,
the.
yes,
Yeah.
that is more
Yeah.
important actually.
No, makes sense. On that backdrop, so we were, we keep again, we keep rattling our minds on this in terms of, acha, fixed income is doing what it is doing, and arbitrage now with STTs, it is doing what it is doing, and BAFs you have to taper expectations, and MAFs or multi assets,
Yeah,
you have equity and commodities, and you don't know when the commodity reversal will happen, and
yeah.
you have other issues there,
Hmm.
right? So on that backdrop, right, I know you don't have an SIF.
Yeah, yeah,
I don't know if it is there in the pipeline or not. Maybe you don't want to speculate on that or comment on that, but still, uh, my question is on your thought process, right? Do you think um, SIFs add value there? Do you think for that particular gap that exists today, do you think like a long short as a category, we've had long short AIFs and all of that before, but then the taxation used to eat up into a lot of returns.
yeah.
But now that SIFs kind of solve that space, do you think there's merit for that particular space, is what I'm talking about, without relatively increasing too much of risk.
Yeah, definitely. Theoretically, there is a merit for this because there is a gap which exists in the overall basket of the product. So there is a merit of that, actually, merit for that. However, the question remains actually is that who is going to sponsor and manage this fund? If that is going to be done in the same manner as any other mutual fund,
Hmm.
then it defeats the purpose actually.
Why do you say that?
That is because to start with, the investment team, the investment people is geared towards thinking in a particular manner
Correct.
for the pure equities piece actually, and that would be different in case of a long short kind of
Of
thing actually.
course.
So that is a different skill set. So that's a different set of people actually, completely different set of people. That's what I meant actually. So the existing set of the mutual fund,
Hmm.
and possibly which is why I think it has to be a different
Separate
company,
brand and all of
separate
that. Yeah,
company
yeah,
also
yeah, yeah,
actually.
yeah.
So that part is taken care of. So it
Hmm.
is very important. So it should not be looked at. It should not be looked at as extrapolation of the existing mutual fund. It would be a completely different organization
Sure,
actually.
sure.
The DNA would be different, the people would be different, and how they actually approach things. If they're not different, then it's just
It
beating
defeats the
the,
purpose, like
yeah,
you
it
said.
defeats the
Okay,
purpose actually.
okay,
The thing is that again, the second thing is that the product should be structured very well actually. So which is the gap which you're addressing?
okay.
So again, there
Let's
would,
assume it's long shot. Let's assume
yeah,
it's that
yeah.
gap between it's that gap between 7 to 10%. That's where I'm
So
you
we
know
are getting into a hypothetical situation because
hypothetical,
I'm
purely
not too sure
hypothetical.
actually what exactly we are doing
Fair.
at our end, especially in the equity side. I'm not too sure on what somebody else has done basically. So let's say it's a pure long shot. So within that also there could be multiple options. For
Correct.
instance, net neutral. For instance, plus 30% or plus 70%.
Yeah.
So that needs to be communicated and that needs to be actually followed through.
Mm.
So I'm not too sure actually is I can give a concrete answer to your question
Fair, fair,
basically,
fair, fair.
simply because we have not actually gone into that actually in depth of which product to actually come up with actually. But the short answer is that there is a space for these kind of products actually.
Okay.
It has to be thought through, and it should be looked at from the different set of people with the same skill set actually. Let me put it this way actually. May not be the absolutely the right analogy, but maybe to some extent, a test player and a T20 player or a whatever T10 player actually, it's not exactly the same, but the some of the skill sets are same, but some of the skills are very, very different.
Okay. Okay.
So let's keep
That's
it that
that.
way.
Okay.
Yeah.
Okay. Okay. Perfect. So you're saying there is a space, but frameworks should be defined very, very clearly, and you're also
Products also.
products should be defined very,
Yeah.
very clearly, and expectations also should be defined very, very clearly.
Yes,
Right.
yes.
Right.
What exactly? Because again, if you're having long shots, you will not be getting a pure equity return.
Of
Actually,
course.
you'll possibly would be getting lower return,
Of course.
but risk managed
And it's
actually.
usually a low beta.
It is has to be. So
Has to be. Yeah.
it can't be both low,
Correct.
high actually. So it has to be low beta, low volatility,
Hmm.
but lower return. If somebody is coming here to get a return higher than pure equity and lower risk, he's bound to get
That's not the
he's
right
bound
way
to
to.
get disappointed.
Okay. Okay. At least in the category like long shot and all you're saying.
Yeah,
Yeah.
yeah.
Yeah. Interesting. Uh, we've now had 10 years of positive nifty returns, right? And the thing with when we started off, we spoke about a lot, macros and all the data that's kind of favoring India today. But honestly, good macros does not guarantee good returns, right? We've seen that play out in China for about 20-25 years now, right? Great GDP growth. We saw phenomenal expansion in capex and all of that, right? Uh, but the market returns weren't great, right? So, I mean, do you think India can enter that kind of a territory, right, where we're constantly talking about good macro, good data, but then the divergence in returns is so much that we're somehow not able to make sense of why this divergence is there? And do you think we'll get stuck in that cycle? Do you think India should be fundamentally prepared? Because uh, market hypothesis kind of teaches us that, okay, if you are coming out from long periods of good returns, you must be mentally prepared for long periods of mediocre returns, right? Do you think India is there?
I think you summarize in the very first statement also. It's again a very good question. So let me say it like this actually. Good macro is a necessary but not sufficient condition for good market returns.
Fair.
Now, you gave example of China. Very fair point that the returns, market returns were below expectation despite very strong macro.
Correct.
Now, think of a situation when the macro also would not have been good actually. Then the market could have been much, much worse actually. So,
Okay.
because there are many other factors also at play for the market returns, most notably things like earnings growth and the valuations, and where there's a corporate earnings cycle, actually, where the corporate earnings is actually in that whole cycle. Now, let's actually come back to India actually. So, India has also seen periods and bouts of kind of modest returns actually, and not too far in the decade of 2011 to 2019, 2020 or so actually.
Correct.
Your market returns were in the mid single digits CAGR,
Correct.
and largely because your earnings growth in that period for the nifty companies was also into mid single digit or so.
Correct.
So it's not a surprise that your the market returns were also that kind of thing actually. Now when you're looking at next 10 years or whichever time period actually, from the market return perspective, the data point which I want to focus on and look at is the share of the corporate profit in the overall GDP. Now, again, if you look at long history, 20, 25, 30 years history, which I remember, then they have fluctuated in the range of 2% to 6, 7%.
Okay. This is corporate profits to
To
a share of GDP.
Yes,
Okay.
yes. So in the midst of the last decade, it was close to 2% or something. It was 7% in 2008, just before the global financial crisis. Currently, you're close to, in the average to upper half actually, so close to 5-6% actually.
Okay.
And which is why you have seen. Not which is why, and the reason you are getting it because the previous 4-5 years after COVID, there was more than 20% kind of earnings growth. And again, if the earnings growth is coming, so this number will remain high. So if it is suboptimal, the corporate profit into overall GDP, then the overall market returns would be weaker, because at that point of time, if we look at the factors of production, then labor is doing better than the capital. But when the corporate profit is doing better, then the capital is doing outperforming the labor, and in that situation, the market returns also would be superior. So we are in a situation of the 5 to 6% kind of corporate profit to GDP ratio. And if we are going to get like FY27 mid-teens kind of growth, which is higher than the nominal GDP, so as long as the corporate earning growth is higher than the nominal GDP growth, that means this ratio will either remain intact or will actually continue to go up. So in that situation, market will continue to outperform. We will not get into the period of the underperformance. On the other hand, if the corporate earnings growth falls below the nominal GDP growth, then this ratio will begin to come down.
Okay.
And in that situation, will go into a situation where the market returns also will be suboptimal.
Right.
I'm trying to simplify and compare
No,
it
absolutely.
with.
That makes sense because this is the conversation we keep having, right? Because, okay, we might enter, good macro kind of territory. All this narrative will continue to be there. But end of the day, what if the markets don't perform, right?
Correct.
That doesn't make any sense, right? So I think you've summed it up really well, sir. Uh, I'm going to ask you one final question, right? And again, many people would have asked you this, but you can choose to not answer as well. But quality, growth, value, momentum, or large, mid, and small, equities, commodities, or bonds, right? Where are you seeing your hypothesis play out in 2026?
See, commodities and bond is very easy. I don't look at
You
them.
don't know.
So
Okay.
yeah. So obviously, equities person, I will say equities actually.
Okay.
The other things are interesting actually.
So
Uh,
equities is your play for 2026. Okay, let's get that out of the.
I have not said for 2026. I'll come to that
Acha,
actually.
okay, fine.
Yeah. So as an asset class, I
As
said.
an asset class. Okay. Okay.
Now, when it comes to growth, value, momentum, quality, etc., again, I'll go back and say some answer which I gave earlier is that the companies themselves do not know what they are.
Okay. Okay.
This is again the levels that we have given.
Fair.
And only after the event, we go back and say
Whether
that
their
this company
value
was
or
a value and this is outperformed or underperformed
fair enough.
actually.
Fair enough.
companies do what they have to do,
Correct.
and we have to figure out and try to figure out whether the earnings growth is sustainable and reasonable with what our expectation is, and the valuation is reasonable or not.
Okay.
And then we go and buy this. Same answer is applicable for large, mid, and small.
Okay.
Because again, the same thing is there. If the earnings growth is sustainable, if the valuations are reasonable, and if the cash flows and the balance sheet is clean, balance sheet is strong, cash flows is positive, free cash flow is positive, then we're happy to own this irrespective of bucket they are in. Later we can put this label that whatever bucket that is in, that is outperformed, because this company
Okay.
will tend to outperform.
So
actually.
you're saying you'll pick up a company with reasonable valuation, with decent growth, right? And obviously good
Cleaner
business, good
balance sheet.
management,
Yeah.
good balance sheet, and later probably you'll give a label whether it was quality, growth, value, or momentum.
Which one has done well in the last year?
Right, whichever is, yeah.
But one part of the question I have still not
Yeah,
answered
yeah.
is that in 2026.
Correct.
Because equities, I don't think it's fair to look at from 1 year perspective.
Fair
Anything
enough.
can happen in 1 year,
Fair
actually.
enough. Fair enough.
It is very important to look from at least 3 year, if not even longer. Even
Okay.
3 year, actually, I'm constrained to say because you asked for 1 year.
No, let's put it this way then. Let's someone coming in now for 2030, let's say.
Yeah, that's reasonable period of time. Then clear cut answer is equities that you should be.
Equities.
That's what I would be actually
Okay.
betting on, and
Okay.
I expect that to do well because I expect this corporate earnings to actually recover, rebound, and now the valuations are also not terrible, which is was about a year and a half back. So I should be expecting a return of my earnings growth in this 4 5 year period.
Right. Thank you so much, sir. This was a great conversation, and you've been great. And this was wonderful for us. And I'm sure we'll talk again sometime soon. And I'll go back to all of these answers,
Sure.
refer them back to you, and then
Sure.
I'm sure all of them would have played out as well, right?
Sure.
So thank you so much, sir. Thank you so much for
No,
doing
it
this
was
with
my
us.
pleasure actually, and excellent questions actually. I mean, it made one thing actually, because many things, many times we take a lot of things for granted, but this questions actually, the question that you posed actually had nuances and layers into this actually.
Thank you.
There are multiple questions.
Thank you.
I hope I've done justice to your
Absolutely,
viewers.
sir. Absolutely.
Thank you very much.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.